Right now, as of 11:08 a.m. Eastern Time on Thursday, November 6th, 2025, SiTime Corp, ticker SITM, is absolutely exploding. The stock is trading at $349.11, which is up $70.04 on the day. That is a staggering 25.10% gain. This isn't a normal market move. This is a violent, decisive repricing of the entire company, and it's happening on massive volume. And while your first instinct, seeing a 25% pop, might be to think you've missed the boat or that this is just a wild speculative fever, the reality of what's happening under the hood is far more specific. This isn't a meme stock rally. What you are witnessing is the market frantically trying to catch up to a new reality that was just dropped on it. The entire narrative for SiTime, and perhaps for the high-performance component sector, just changed overnight. The market expectation was that SiTime was in a recovery from the painful electronics and semiconductor down cycle. The reality, as proven by the earnings report released yesterday after the bell, is that one part of its business isn't just recovering, it's in a full-blown hyper-growth acceleration phase, and it's being fueled by the single most powerful trend on the planet right now: artificial intelligence. Let's establish the common ground, the story everyone used to tell about this stock. The general belief about SiTime is that it's the undisputed leader in MEMS timing solutions. These are the tiny silicon-based components that are replacing old-guard quartz crystals, acting as the heartbeat for all sophisticated electronics. The long-term expectation has always been simple. As 5G, IoT, smartwatches, and advanced cars become more complex, they need better, smaller, more reliable timing. SiTime provides that. It was seen as a key disruptive supplier, a pick-and-shovel play on the future of tech, almost like finding an early Nvidia stock or Tesla stock in the component world. But for the last 18 months, that beautiful story ran into a very ugly reality: a massive post-pandemic inventory glut. Customers were stuffed with components, orders dried up, and the stock got punished. The expectation became one of a slow, painful grind higher as this inventory was digested. Well, yesterday's Q3 2025 earnings report took that slow grind narrative and threw it directly into the shredder. This 25% launch today is a direct reaction to numbers that didn't just beat expectations, they obliterated them. The company reported non-GAAP earnings of 87 cents per share, crushing the Wall Street consensus of 71 cents. Revenue came in at $83.6 million, sailing past the $78 million estimate. But that's not even the real story. The CEO, Rajesh Vashist, said it plainly: AI growth powered milestone revenue. The company's communications, enterprise, and data center segment, the part of the business selling high-performance timing solutions for AI servers, optical modules, and high-speed switches, grew an astonishing 115% year-over-year. This is the sixth consecutive quarter of triple-digit growth for that segment, and it now accounts for over half of the entire company's sales. This isn't a recovery, it's a breakout. Management didn't stop there. They issued guidance that they now expect full-year 2025 revenue growth to exceed 50%. This is the very definition of reality exceeding expectation. The market was pricing this as a cyclical company tied to the broad electronics market. The reality is that it has successfully hitched its wagon to the AI infrastructure build-out, which is not cyclical, it's a secular tidal wave. This changes everything for the stock's valuation. It's no longer just a component maker. It's now being viewed as a direct AI infrastructure play. This is why you're seeing such a dramatic move. A move like this sends shockwaves through every investing site. People doing self-investing on platforms like the Robinhood app or SoFi Invest are seeing this at the top of the gainers list and piling in. But the real move is being driven by institutions that are being forced to reevaluate their models. They're looking at this guidance and realizing their estimates for 2026 and 2027 are suddenly far too low. This is the kind of investment that separates a simple Fidelity ETFs holder from someone doing deep stock-specific analysis. Naturally, Wall Street is scrambling to catch up. Stifel, for example, came out this morning and raised its price target on SiTime from $320 all the way to $360, maintaining its buy rating. The analyst noted that the company's clock business funnel has quadrupled to $300 million in the last year alone. This isn't just about one good quarter. It's about the pipeline suggesting this AI-driven demand is sustainable and, if anything, still accelerating. This is the kind of data that professional traders on Interactive Brokers live for. They see the earnings beat, the guidance raise, and the analyst upgrade, and it's a clear go signal, helping to fuel this massive gap up. The volume today is already immense, showing genuine institutional conviction behind the move. It's far beyond what you'd see from just retail Robinhood stock trading. But now we have to introduce the new tension. The expectation has now shifted. The new expectation, baked in by this 25% jump, is that this hypergrowth is the new normal, and that the stock deserves a much, much higher multiple. But what is the new reality? At $349 a share, SiTime is now trading at a very rich valuation. By some measures, like Investing Pro's fair value models, calculated before this jump, the stock was already considered overvalued. Today's move pushes it into rarefied air. This is where online investing gets extremely difficult. Is the stock now fully valued? Or is it just starting a new leg up, like Nvidia stock did when the market realized the AI potential? And here's a fascinating and complicating piece of data. SEC filings from this week showed that the company's own CEO, Rajesh Vashist, sold 2,000 shares of his stock on November 3rd, just 2 days before this explosive earnings report. The sales were around $290 per share. Now, we must be fair. Executives sell stock for all sorts of reasons: diversification, tax planning, buying a house. It's often part of a pre-planned schedule. But the timing is, to put it mildly, interesting. It creates a new tension. The CEO presents a picture of explosive, ongoing growth, yet he was a seller just 48 hours before that picture was revealed. This is the kind of nuance that an automated, intelligent portfolio from a service like Schwab Intelligent Portfolios will never catch. It's the kind of data point that active managers at a place like Fidelity Wealth Management or a trader using the Interactive Brokers platform would be debating heavily right now. Does it mean he thinks $290 was a good price? Or was it just a drop in the bucket of his total holdings? It's a crucial part of the reality check. So let's step back and look at the company itself for those who are just now discovering it because of this move. SiTime, based in Santa Clara, is fundamentally a technology disruptor. For decades, every electronic device, from a quartz watch to a complex server, needed a timing device to create a stable clock signal, the drumbeat that synchronizes all its operations. The default technology was a small, vibrating piece of quartz crystal. It was cheap and it worked. SiTime's entire business is built on the idea that quartz is obsolete. They create their timing devices using MEMS, or microelectromechanical systems. These are microscopic silicon structures that vibrate at incredibly stable frequencies. Their business model is fabless, meaning they design these MEMS devices and the accompanying analog circuits, but they outsource the actual manufacturing, primarily to industry giants like TSMC and Bosch. This allows them to focus on design and innovation. Their products, oscillators, clock generators, and resonators, are superior to quartz in almost every way. They are dramatically smaller, consume less power, are far more resistant to shock, vibration, and temperature changes, and, this is the key, they are programmable. This makes them ideal for the harsh environments of 6G infrastructure, industrial automation, and automotive systems. But their killer app, as we're learning, is in the high-performance computing space. The massive data centers being built for AI, filled with GPUs that look like advanced cousins of what's in Apple stock-powered devices, require timing solutions that are exceptionally precise and stable at high frequencies. That is SiTime's sweet spot, and it's what is driving this 115% growth in their data center business.